Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Dryden Pence, Chief Investment Officer of Pence Capital Management. We also have Ben Slavin, Global Head of ETFs at BNY, Katrina Schmaltz, Managing Director and Portfolio Strategist at Nuveen, and Lydia Boussour, Senior Economist at EY. We're here to discuss why inflation rates and Fed policy are dictating behavior across virtually all asset classes. It is great to have everyone with us. Welcome to Trade Talks. And Dryden, let's kick it off with you and talk about the macro environment, because I think that what we really have been focusing on is the bifurcation that we're seeing within the economy.
Well, there is a bifurcation, but you also have to kind of take a look at the fact that most people don't realize we've added 6.1 million people have jobs. You know, that's more. We've added 6.1 million people since the peak right before COVID. So when you do the math around that, that's like adding the entire labor force of Georgia, or adding the entire GDP of Italy to the economy, $2.5 trillion, and that stimulates a lot of aggregate demand. But then they do kind of bifurcate in that. But the overall aggregate demand is going up because Americans, if they have money, they spend it. You give $2.5 trillion into the economy, it's going to get spent. And so I think this is where we are now as we're moving this adjustment. It's like we've been driving a car at 90 miles an hour. You slow down to 50, you feel like you're going slow, but you're still moving 10 times faster than you can possibly walk. And so you've got this moment where it's a slowing of the economy, and people may feel like they feel the difference, but it's really not a bad situation. It's just moving from toward pace to sustainable pace. And I think that's one thing that we've got to pay attention to.
You know, but we know household excess savings, it's quickly trending below since, the excess savings that we saw during the pandemic. But I think it's the way that consumers are perceiving the economy relative to the data that's being presented. It's two very different worlds. They're not feeling that good about it.
Well, look, I think it's a great point what you just raised, in that, what we see is a market dynamic that's slowly shifting, and we're seeing that play out in the data. Now, if you look at, for example, the ETF market, we've seen over 320 billion come into ETFs. Actually, it's on pace for second all-time with over 800 billion if it plays out for the rest of the year. But what you're seeing is that money come across all asset classes, and some of the positioning shows that advisors and the retail investors are also trying to position themselves in this environment. I think on one side you saw a lot of cash come into money market funds over the past year or two. Some of that money may come off the sidelines, but at the same time, the data that we're seeing shows that, really that household savings rate is starting to come down. So there's a, really question about where that money is going to go. But we're also seeing, again, a lot of movement and some volatility in those rate-sensitive ETFs that are really obviously prone to watching what the Fed is going to do and those expectations going into the end of the year, for sure.
Yeah, and Katrina, you sit on a multi-asset portfolio construction team, so you're seeing this across a number of asset classes.
Yeah, absolutely. So as I mentioned, I'm on portfolio construction team, so we're always thinking about how the macro environment maybe dictates portfolio positioning, and those two things go hand in hand regardless, right? They're very interrelated, but we feel particularly now the macro is inescapable. We have inflation, the Fed, and rates dictating behavior for all asset classes. And in a regime that we're in that's characterized by these high rates and still high inflation, you as an allocator, you can no longer rely on the cross-asset relationships that you could formerly lean on. So inflation has a way of throwing these things out the wayside. So that's another way you have to adjust your portfolio construction. And then the third way is that this environment with just high interest rates, certainly high rates, inflation as well, but really high rates, creates winners and losers. It creates market dispersion, it creates bifurcation in the economy, but just some year-to-date numbers, we have U.S. large cap growth up 16%, we have U.S. small value down 3%, we have tech up, obviously, we have utilities up double digits as well. And in the emerging market space internationally, we have Taiwan up double digits, obviously an AI play, but then we have economies like Brazil that are down. So no shortage of dispersion numbers to quote. And I think the main question, though, is can the U.S. economy continue to grow despite these high inflation and high interest rate headwinds? And you can sift through the data and try to find ways to answer that question. If you're looking for a rosier spot to land, you can look at Q1 earnings. We had 80% of earnings beat consensus. There's probably a couple of different reasons for that. It's household, consumers, and corporations have just been able to lock in lower rates, right? So perhaps the economy is just less interest rate sensitive than we all anticipated. And then of course we have fiscal spend. We have CHIPS Act, Inflation Reduction, and Infrastructure Act. So less interest rate sensitivity coupled with fiscal spend tends to be supporting things at the moment.
And Lydia, let's talk about the U.S. consumer for a moment here, because that is where you're seeing some bifurcation in terms of different groups of consumers exercise their scrutiny in one category or the other.
Yes, that's right. Going back to that bifurcation, I really think that we're seeing some of that both in the consumer sector but also in the corporate sector. When we look at the consumer side, we are seeing more signs of strains in lower income households but also younger households, and it's really a reflection of the fact that this tightening cycle and the fact that we have still elevated inflation, you were talking about inflation perception, still high interest rates, this is being felt more by lower income households and more fragile households, financially speaking. On the corporate side, we're also seeing that bifurcation happening, both between corporations and small businesses. And we got the data on the NFIB, from the NFIB survey showing that small businesses are growing more downbeat about the outlook, and they're feeling that tightening in lending standards. And so all of that is really showing that beneath the surface, we still have a strong economy, but there are some pockets of softness. And I think if you take a step back and look at the overall macro picture, and you move away from this shifting narrative, we started the year with an economy that was reaccelerating. Now we're in this narrative that the economy is slowing too quickly. Really, what we are is in an economy that's gradually decelerating. We have consumers, lower income consumers that are becoming more cautious with their spending, more selective with their spending. We have companies also becoming more increasingly cautious with hiring and investment decisions. And that's going to continue to put downward pressure on inflation. I think it's important to keep in mind that we are still in a disinflationary environment, and that if you look at the next 6 months, we're likely to remain on that gradual disinflation path. Despite the bumpiness in inflation in the first quarter of the year, I do think that we're going to continue to move in the right direction because the labor market has rebalanced. We're seeing signs of softness beneath the surface, and because consumer demand is also softening. And so this is, in general, more supportive of disinflation going forward.
Right. We think about how the Fed is developing their policy around this, Dryden. There's a couple of things here. We went into the beginning of this year with perhaps 6 to 7 rate cuts. It never happened. The market has improved on fundamentals, as to Lydia's point about earnings. But with the consumer lower end particularly, they're struggling because they're accessing more debt. Interest rates are higher end consumer, higher interest rates means more savings, right, more rate on their savings. But the fact of the matter is, even if the Fed comes in and cuts once or twice, 3 times, I don't think anyone's pricing in 3 times, are those 25 to 75 basis points really going to move the needle for consumers that are struggling? Because when you talk about disinflation, using round numbers, if inflation has not gone up 0% year over year, they're still thinking, well, things are 20 to 25% more expensive pre-COVID. I mean, we see it everywhere. So you have to think, from the consumer perspective, the dollar's not going as far as it used to.
No, a 25 basis point cut or 50 basis point cut, get 2 or 3 or whatever, right. It's not going to make a big change to someone who's paying 15% on their credit card. Mm-hmm. And so when you look at that, it's kind of this situation of the bifurcation of the consumer. I think the lower part of it, they're being more affected dramatically by inflation, and they have been, but we talk about inflation being at least more stable. It's directionally correct, but the easy work's been done. 9 to 3 is a heck of a lot easier than 3 to 2.5, and we think that's going to take a long time. But the other side of it is, if you go back to 1971, we've spent over half our lives with inflation over 3%. And we did okay. We had an economy that grew at about 6%. We had a stock market that compounded at about 7.5%. So it's just we have a recency bias of 1 to 2% inflation. We have an actual longer term bias of an economy that worked actually reasonably well at about a 3%. And I think that's one thing that everybody's dancing too much on the head of the Fed's pin. And 25 basis points, 50 basis points, it's not going to make that big of a difference. But what's important to consumers is they have a job, and they have the ability to work and make income, and we're seeing some stability in wage rates. So I'm not as gloomy as everybody else is. I think 50 miles an hour is pretty good if we can get to a sustainable pace in the economy.
Well, maybe a great point, recency bias. I think that's really what the challenge is then.
Yeah, and certainly this is something we've seen play out around the world as well. And Americans hate inflation for sure, but this is something that we've seen, for example, in Europe. And again, to the point earlier, we've seen inflation start to cool in Europe. In fact, the ECB just started to cut rates. And honestly, we've started to see some investors, again, positioning around that. And we've seen the sentiment in at least European equities start to turn positive. But again, some of the same sentiment that we're seeing here, but playing out again around the world.
I agree that I think there's too much focus on that first rate cut. I think this is something that's happening. And really, the way we think about it and the way we look at it is really that the Fed is embarking on a recalibration of monetary policy and really moving away from that restrictive monetary policy stance and trying to avoid having that hard landing of the US economy, putting too much downward pressure on the economy, and really trying to extend the cycle, this economic cycle. And I think this is a risk that we are really aware of and that we need to be cognizant of. The fact that we are still, the monetary policy is still quite restrictive, and the Fed is extremely data dependent and looking at backward looking data. So really, I think in this, in the economy we are in today, which is a cooling economic environment and still a disinflation environment, when we look at the data and where we're heading, I think the optimal approach in this environment is really to cut interest rates sooner rather than later to avoid, pushing the economy really kind of over the edge.
It's hard to put the inflation genie back in the bottle a second time.
Especially going into an election.
Yep.
Right. I mean, that's just going to be the narrative. So we're going to hear more about this ad nauseum, whether we want to or not. So when you think about positioning Katrina or more attractive areas of the market, what looks like it could hold up in this kind of environment?
Sure. So speaking to the election too, there's 77 countries, which represent 60% of global GDP, hitting the polls this year. And so we certainly think we would not be surprised to see some expected volatility over the summer because of that. And with that sheer volume of election going on, we think there's going to be some surprise outcomes. And we've already seen a little bit of this last week with the Indian election, Prime Minister Modi's party underperforming at the polls. He had to survive on coalition support. And then we saw something similar in South Africa, actually. The long dominant ANC, was formerly the party of Nelson Mandela, was also rebuked at the polls. They also need to trying to wrangle coalition support. So just two examples of what could be some shocks that pop up here and may move markets here and there. Another comment on the elections. I won't pretend to offer insight on the election outcome for the US election here. But what we know about elections from a multi-asset portfolio perspective and from looking at different asset classes, we try to caution our clients from positioning portfolios for election outcomes. It's very hard to get an election outcome right or an event outcome right. And you actually have to get two things right. You have to get the election outcome, the candidate, and then you have to get the market reaction. And the chances of getting both of those right is pretty low. So 2016 could be an example. A lot of folks and managers positioned for a Clinton win. They thought markets might appreciate that versus the unknown Trump candidacy. And the exact opposite happened, right? We had a Trump win, markets ripped on pro-business sentiment. So those managers actually in that case, two wrongs did make a right. Like if you positioned risk on, but that was luck, not skill, and we always want to be applying
market timing is
skill.
largely luck. I mean, that's market timing in general, but when we think about areas of the economy to invest, Ben, in my mind, infrastructure and technology, as you point out, regardless of who gets in, I mean, these have to be priorities.
Yeah, absolutely. And I think, certainly we're seeing exactly what you just mentioned play out with, again, how investors are positioning. So certainly like on the fixed income side, we're seeing a lengthening of duration without a doubt, obviously seeing where rates might go and wanting to lock in those higher yields. I think certainly, look, it's a momentum-driven market, or has been, but I think a lot of this uncertainty is actually driving some flow back into active management. Yeah. So we've seen, like in the ETF space, it's about 8% of the market, but this year it's over 30% of the flow. So it's almost 4 times its weight, which has been honestly an anomaly, or at least something that hasn't been on trend the last couple years. Gives you some indication about how all this uncertainty is really playing out versus the geopolitical, the election, et cetera. And I think one more thing, I think certainly in technology, that concentration in the S&P as well, those valuations is certainly in the top 5 being about 27% of the index, also kind of impacting some investor psyche as well, just where valuations and where the markets run.
Yeah, but I feel like you're starting to see somewhat of a rotation in that trade anyway. I mean, we saw utilities as one of the best sectors in May because you could, have all this technology, but you need the power to run it, right? So we saw that rotation trade into energy and into utilities.
Yeah, the other thing when you talk infrastructure, though, I mean, getting back to basics, there's 167 million crossings across deficient bridges in this country. I mean, if you took all the bridges in this country that are really in bad shape, lined them up, it's like 6,500 miles. And so, the politicians can at least agree on one thing, is that we have to do this. And so you've got this large infrastructure spend. You've got about 580 billion allocated or authorized. They've only allocated about 250 billion of it. So there's a lot of money to go. You're throwing that much money at construction across this country. It's going to frustrate people a lot because all the bridges are going to be rebuilt. But it's also going to make a big difference for the companies that are in that business because we have to rebuild it. Otherwise, our infrastructure's falling apart.
We're commuters, we know.
All you commuters, exactly.
But to your point about the economy and the strength of the consumer, those are good paying jobs.
Exactly.
Right, and that can only help in terms of spend because to your point, we like to spend as quick as it comes in.
We spend it as fast as it comes in, and we need to get to work, and so we're going to go across the bridge. We got to rebuild the bridge. It's just pretty basic fundamentals.
We also like infrastructure. We think it could do well if we see some softening in the U.S. economy, and we think it can also still do well if we see some high inflation. So kind of either way you go, or still high inflation. Either way you go, we think infrastructure is a nice place to hang out. We also like municipal bonds. The muni bonds have been the beneficiaries of a number of municipalities have been the beneficiaries of a number of round of COVID financing. They're in really strong financial shape. And you can do a tax equivalent yield on municipal bonds if you take the highest tax bracket. Muni bonds now are offering around 5.6 on a taxable equivalent basis to 6.7. That's higher than agency MBS. That's higher than investment grade credit. So for high net worth individuals, we think they offer some really attractive yields, and they have historically had pretty low defaults as well.
Yeah, and Lydia, you point out in your notes here too that patience and prudence is a virtue as well in this type of environment.
It is, yeah. Thinking about what we talked about earlier, the fact that there are some pockets of weakness, that the economy is cooling beneath the surface, and that really in this environment, keeping interest rates too high for too long could potentially be a risk. And when we look at, for example, the labor market, we've seen a lot of normalization, and it does look like, looking at many indicators, looking at job openings, we're looking at 1.2 job openings per unemployed workers today, which is pretty much in line with where we were pre-pandemic. We're looking at people quitting their job at a lower pace than before the pandemic. So there's been a lot of normalization, and the unemployment rate has also been gradually drifting higher. So I think we do need to be, more cautious in this environment and really allow for this economy to continue to run through 2025. We're still expecting growth to be quite solid this year. We're looking at 2.4% growth in the US with a gradual slowdown throughout the year and then a gradual rebound and firmer growth in 2025. So still a good, solid economy, but some signs that it continues to slow and soften beneath the surface.
Yeah, and Ben, to wrap up here, on the other side, not exercising patience, advisors sometimes fall into that trap where they're afraid they're going to miss the timing of the market or get caught offsides.
Yeah, and certainly, again, that fear of being caught off sides is, again, what we're kind of seeing in the market. So I kind of mentioned earlier, certainly what you see in flow on fixed income and that lengthening of duration is sort of one piece of that. We're also seeing, again, a lot of flow starting to chase some of these markets, which, again, is an old story, but again, playing out once again. But there are a few niches where we're trying to see investors try to at least position themselves for some better upside. So again, European equities, we saw the run up in utilities, something that hasn't been on the leaderboard for quite some time, and here we go. So we are seeing some of those pockets, but again, a lot of concern and a lot of dispersion in that data, given everything we've talked about today.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. All right, all clear. Very